Here now we have the normal group POL. You get to know. I'm trying to bring out the content so that we can have an idea of what we'll be discussing. Group POL, we have the mid-year acquisition. This normal POL that includes maybe parent company, subsidiary, and associate. There's need for us to talk about the transactions that occur between the group. You get it now, because these are the transactions we would have to adjust. We'll make adjustments. We will now solve the question. We'll treat those adjustments in questions. Basic issues to be treated in the Consolidated Statement of Profit or Loss intra-group sales, right? So the intra-group sales now, it occurs when an entity in the group sold to another entity within the group. They get, like, for example, parent company sold to the subsidiary company. Treatment for that is you debit the consolidated revenue and credit cost of sales. This is Roman figure 2 is the intra-group sales will give rise to unrealized profit, right? So, and unrealized profit, the way we treat it is it can be in two ways, right? It can be upstream or downstream. It involves converting markup to margin and converting margin to markup. Each month's acquisition. Knowledge sales to application were consistently 4.6 million, and knowledge had marked up by 15% on cost, and application had 1 month supply, that is 4.6 million of these goods in inventory. So here now the realized profit now, it is what we are doing is we are going to deduct the that is applicable to the unsold portion, that is the margin multiplied by the unsold portion of the inventory. The treatment is you debit the retained earnings of the seller, then you credit inventories. So now the example one now, let's now calculate the unrealized profit now on inventory. First of all, determine the margin, right? And they told us that it is marked up by 15% on cost. And here we are given the sales value, so which means we need to convert markup of 15% to margin. Margin would be 15 over 100 plus 15. You get it now? That would be 15 over 115. You get it now? That would be the margin. So the unrealized profit will now be 15 over 115 times. So the unsold portion now of the inventories, now look at it. They said the application had 1 month supply, and the 1 month supply amounts to 4.6 million. So that's 15 over 115 times 4.6 million. 600,000. First of all, need to treat the intra-group debt, right? So intra-group debt here would be what? So they said consistently, each month since acquisition, knowledge sales were consistently 4.6. That is, each month the listing was consistently 4.6. So let's now assume that the post-acquisition period is 12 months, right? Is an assumption. So which means the total intra-group sales will be 4.6 million times 12 months. Unrealized profit will be debit cost of sales. You get it now, and we credit inventories. So that's in respect to the Consolidated Statement of Profit or Loss, right? So that's it. Then impairment of goodwill. The treatment, it would be debit administrative expenses. Then you credit goodwill. The acquisition, this refers to when the parent company acquires a subsidiary company during the year. It is the post-acquisition period year is less than 12 months. You get it now? So if it is less than 12 months, then it makes it a media acquisition. This media acquisition now, it will affect let me just say, to affect the statement of financial position. Statement of profit or loss. You get it now, it will affect it majorly. That's it, because here now what we are trying to do is would prorate the items in the statement of profit or loss of the subsidiary. You get it now, the subsidiary. And here now, let's take a look at this example. The third statement of profit or loss for the year ended 31st March, right? 20x9. First thing first, all we are going to do is the workings one. And workings one is the group structure. The group structure here now, say Ethos acquired 75% of Pathos, non-controlling interest will be what? That's 25%. That be date of acquisition is what? That's 30 November 20x8. So then the date of reporting is 20x9. So what's the post-action period? Okay, that's December, January, February, and March. Okay, correct. That's 4 months, right? So which means this means that every item in the statement of profit or loss for Pathos will be multiplied by 4 over 12. That's it. So this should be 303,600 plus 4 over 12 of 217,700. Cost of sales, right? That's 143,800 plus 4 over 12 of 102,200, right? Then we have our gross profit. So gross profit, we have the operating expenses. Operating expenses, we have the 159,800 plus 4 over 12 of 115,500. Profit from operations, investment income 2,800 plus 4 over 12 of 1,200. We have profit before tax. Profit before tax. No, we have income tax expense. Then that's 46,200 plus 4 over 12. 4 over 12 of 32,800. Do we have any intra-group debt? Let's just say 167. Next is what? 866. Gross profit is this minus this. Operating expenses is what? 198,300. Okay, profit from operation would now be this minus this. 3,200. Profit before tax is this. Sum of the two. So then the income tax expense is 57,133. So what will now be the profit for the year? Profit before tax minus the income tax expense. So we now say profit for the year attributable to owners of the parent. And we have the non-controlling interest. The owners of the parent, as you all know, will be the balancing figure. In NCI now, it will be 25% of profit for the year. And the profit for the year is what? 32,800, right? 8,200. And total year is minus 53,933. This will now be balancing figure. This is supposed to be 71,200, right? Then 4 over 12 of 51,500. 51,500. Here's profit for the year. The profit for the year is 56,000, right? The non-controlling interest, yeah, sure. You multiply by 4 over 12. That's post acquisition. So please multiply this one again. Okay, yeah.